Okay, let's dive right into this explainer and really decode the massive structural regime shift happening in the Indian real estate market today. Now, if you've been tracking property trends, you already know that post-pandemic years were just an absolute whirlwind, right? Rapid growth, soaring valuations, the whole shebang. But as we step into 2026, the landscape is transforming completely. We are entering a phase that experts are officially calling the Great Consolidation. It's no longer just about riding a wave of easy liquidity. It's about strategy, execution, and pinpointing very specific pockets of value.
So you might look at the recent stabilizing sales volumes across major cities and think, well, the post-pandemic party is ending. It's a totally fair question. Is the boom over? But the data actually tells a much more fascinating story of a market that is rapidly maturing. We aren't seeing a broad market correction or some massive crash. Instead, we're seeing demand evolve. The sheer volume of transactions is leveling out, sure, but the actual value of those sales is climbing because buyers are shifting their focus. The market isn't shrinking, it's truly growing up, and it's demanding a lot more from the people building it.
For the longest time, developers operated on the old playbook. It was highly speculative, purely volume-driven, and based on the frankly unbelievable assumption that if you build it pretty much anywhere, buyers will eventually show up. Let me tell you, that era is definitively dead in 2026. The new playbook is strictly disciplined, it's value-led, and it is hyper-focused on execution. Developers are actually aligning their project launches with real absorption rates to keep inventory overhang low. It's a massive flight to quality, meaning developers who can actually deliver what they promise on time are the ones taking all the chips off the table.
So, here is our roadmap for decoding this shift today. We'll look at the new housing regime, the great execution gap, the undeniable rise of premium housing, what's happening beyond the megacities, and we'll wrap it all up with a smart buyer playbook.
All right, let's kick things off with Section 1, the new housing regime.
The absolutely crucial point here is that we've entered the Great Consolidation. The underlying fundamentals of the Indian economy are incredibly robust right now. I mean, we are seeing a projected 8 to 10% wage growth for 2026, which is putting significant capital into the hands of homebuyers like you. Amplifying this is the RBI's recent 100 basis point rate cut from 2025. That cut successfully stabilized affordability and essentially brought mid-segment homebuyers right back into the action. But here's the catch, and it's a big one. All this new purchasing power isn't being distributed equally. The market is strictly rewarding developers who execute on time and heavily punishing areas with massive localized inventory overhangs.
Buyers are armed with better purchasing power, but as Knight Frank India points out, the market is becoming increasingly selective. Premium homes are driving growth, while affordable housing actually remains under pressure. Today's buyers are far more discerning. They're prioritizing construction quality, reliable developers, and long-term value over simply hunting for the lowest entry-level price. Because affordability challenges are still weighing heavily on the lower end of the market, budget housing is struggling with real supply constraints. The end result? Today's home buyers way less speculative and far more demanding.
And that brings us right into Section 2, the Great Execution Gap.
The data shows a really dramatic contrast between cities right now. Disciplined markets like Noida are compounding at a staggering 23% over 5 years, making it a massive winner. Pune is another huge success story, where developers actually listen to buyers, dropping unsold inventory to a 12-quarter low. But then look at the IT capital, Bengaluru. You'd think a city built on tech could manage a basic construction schedule, right? But they are drowning in over 87,000 unsold units, hitting a 20-quarter peak. Why? Because an astounding 214 projects missed their rare mandated timelines in just 1 quarter. Buyers are understandably losing confidence, and pricing power in those stagnant areas is taking a massive hit.
And this execution gap, it extends to the city planners too. Gurugram literally lost its historical pricing premium to Noida specifically because today's buyers are fiercely penalizing cities with drainage failures and severe traffic congestion. Gurugram saw prices correct by nearly 20%. Just think about the severity of that penalty for a second. Civic infrastructure is no longer just a nice-to-have background detail. It is a strict, undeniable pricing input. If the roads flood and your premium postcode literally washes away in bad drainage, your real estate valuations will collapse right along with it.
Which perfectly tees up Section 3, the rise of premium housing.
54%. That massive number represents the share of total sales captured by properties priced over 1 crore rupees in just the first half of 2026. Let that sink in for a moment. The luxury tier isn't just for the top 1% anymore, it's literally the absolute majority of the market.
Premium housing is firmly the new anchor of the market. This is a massive shift from just a few years ago. It's being fueled heavily by rising domestic wealth, thanks to that wage growth we talked about earlier, and intense participation from NRI buyers. These demographics aren't just looking for a basic roof over their heads. They are demanding a complete lifestyle upgrade. They want amenities, they want security, and above all, they want space.
And here's the reality check for developers who are still trying to cut corners. The old myth of shrinking floor plans to maximize margins is completely over. For a decade, developers tried to charge more per square foot while offering smaller and smaller apartments. Well, in 2026, buyers are simply refusing to play that game. If new units feel too cramped, or if a project is delayed, buyers are effortlessly pivoting to the secondary market to grab older, larger resale stock. Developers who don't offer genuine, spacious utility value are just getting left in the dust.
So let's look at Section 4, Beyond the Megacities. Where is all the institutional capital flowing?
$8.5 billion. Institutional investment in Indian real estate just hit an all-time record of $8.5 billion in the first half of 2026 alone. That marks an incredible 32% jump from the previous year. It shows massive confidence, for sure, but the truly fascinating part is where this smart money is actually going. It isn't just blindly pouring into the old, saturated megacities anymore.
Capital is aggressively migrating out of those saturated hubs. It's flowing into a diverse array of Tier 2 transit-oriented markets, like Sonipar, Indore, and Rohtak, places that are directly benefiting from massive new transport corridors. Beyond just residential, the smart money is busy building the digital and physical backbone of the new economy. We're seeing massive investments in data centers targeting 1.7 gigawatts of capacity and logistics with over 50 million square feet of leasing expected this year. Future valuations are now deeply and permanently tied to connectivity and digital infrastructure.
Let's bring it all home with Section 5, the Smart Buyer Playbook.
If you're investing in 2026, this is your strict, non-negotiable playbook. Number 1, you have to demand RERA compliance and avoid delayed projects at all costs, because delays destroy capital. Number 2, heavily scrutinize the developer's historical track record. If they didn't deliver back in 2022, absolutely do not trust them in 2026. Number 3, take a really hard look at the local civic infrastructure. Literally, go check the drainage and the traffic patterns during rush hour, because future buyers certainly will. And number 4, buy where the new transit links and infrastructure corridors are actually being built, not just promised on a billboard.
I want to leave you with this final, provocative thought. Take a hard, honest look at the civic infrastructure and the developer discipline in your own neighborhood right now. Based on everything we've covered today, is the area you are looking at compounding its value through reliable execution, or is it secretly stagnating under a massive mountain of delayed oversupply? Because in the great consolidation of 2026, promises mean absolutely nothing. Execution is literally the only thing that pays.